Ever questioned what a bond is? Picture it as a loan extended to a country or corporation, with a set beginning and end, with pre-specified terms and conditions called a bond prospectus, in terms of return earned by the bondholder throughout the bond's life cycle. The government or corporation, they are called the bond issuer, compensates the bondholder with either a fixed or variable rate of return or combination of two. Upon issuance, a bond's price is a fixed value, often referred to as 100. Throughout the bond's lifetime, this figure can rise or fall, becoming volatile. This volatility is influenced by several factors, the central two being international interest rates and the bond issuer's rating. To illustrate, consider international interest rates. These rates set by central banks have an inverse relationship with bond prices. When interest rates rise, bond prices fall, and vice versa. Imagine a seesaw. As one end goes up, the other goes down. Now, let's move to the bond issuer's rating. International rating companies regularly revise these ratings. The higher the rating, the lower the interest demanded by bondholders, and conversely, the lower the rating, the higher the interest demanded. Imagine a time when Israeli bonds were downgraded by rating agencies. The interest demanded by bondholders rose in response. There are many other factors influencing bond prices, such as liquidity of the bonds, issue size, interest rate payment terms, where are they traded, currency fluctuations, and default features. However, the bond's price sensitivity is highly correlated with its remaining time till maturity, also known as its tenor or duration. The longer the tenor, the higher the price sensitivity. As maturity approaches, this sensitivity diminishes and the bond returns to its original value of 100. At maturity, the issuer is expected to repay the bond's value to all investors. However, difficulties may arise, preventing repayment. If an issuer defaults on payment, the bond becomes a defaulted bond. Bond owners may then agree to restructure the bond's maturity and terms, extend the repayment of the principal and interest, or write off and lose their investment. Bonds can default and investors may lose some or all of their promised interest or their initial investment. But investment-grade bonds are considered a safe investment, as it pays a coupon and overall default ratio is bonds are within the acceptable norms. However, non-investment grade bonds are considered speculative and has more risk versus investment-grade bonds. Take, for example, successful restructuring like Greece or Spanish bonds and defaults like Lebanon or Sri Lanka. In conclusion, bonds are complex financial instruments with their price volatility, potential for default, and a life cycle from issuance to maturity. They are influenced by various factors, including international interest rates and issuer ratings. Despite the risks, they remain a vital part of the global financial landscape, providing a source of funding for governments and corporations alike, and our current economic system can't continue without having them, unless we change our worldwide economic system to a new system which can create a substitute to funding. Can you suggest one? Think of it and let us know in the comments below. This report is brought to you by Kawami's Financial Services. We bring transparency and financial education to all users all over the world. Please like, share and subscribe to our channel to receive our latest report. Kawami's means financial knowledge is power.